Hey guys, welcome to the Stefan Livera podcast, episode 12. My guest today is McCook. Hey thanks for coming
G'day.
on the show.
How's it going?
Okay guys, so is an engineer by training. He works as a project manager and he's done a lot of work on Bitcoin and energy usage, including some earlier work that many of you probably would have seen already from 2014 and 2015 that I've actually noticed many Bitcoiners sharing that work around on social media, on Twitter and Reddit, Bitcoin subreddit. Now, I actually first met years ago back in a Sydney Bitcoin meetup, and he has now just recently come back into the scene, and he's written up a very detailed, meticulous research report on Bitcoin energy usage, and it's called "The Cost and Sustainability of Bitcoin." So I thought it would be fantastic to get him on the show and just kind of talk through some of the analysis. So, let's start with your story in Bitcoin.
As you mentioned, I was an engineer by background, civil engineer. Spent my early career building big things, highways, bridges, tunnels, all that good stuff. After that, I went off to England, to Oxford, to do an MBA. Where my eyes were opened to kind of the big social issues of the day, and how to fix the world through social entrepreneurship. But I quickly realized, after diving in the economics books, that nothing can really be achieved unless we change the central banking model. So those other things are all nice and good, but the big prize is sound money.
Great.
So that's why I got into Bitcoin.
Excellent. Yeah. So let's now. So you've released this report, and it's out in August, and the data is as at block 534,240. So basically the end of July. Do you want to give the listeners just an overview on the report and what your approach was?
So basically, the report aims to capture what a typical expenditure is on buying new mining hardware and paying the electricity bills for every difficulty cycle, and dividing that by the amount of coins mined and earned by fees to determine a per coin cost. Now, with that said, the model is quite multivariable. There's 6 or 7 variables that have to be looked at. Each one extremely sensitive, to your assumptions and best guesses. However, the big portion of the report is about the underlying economics that feed the assumptions into the price model. So you really can't understand environmental impact without understanding economic impact first.
Sure. How about you? Let's go into the economic impact.
Yeah. So in terms of economic impact, it's not so much economic impact per se. It's just the economic cost, or what you have to pay to produce a Bitcoin. So if you dig into the detailed economics of perfect competition and the nature of competition in the Bitcoin market, the theory is that in times of low hype, the cost of mining a Bitcoin will be near about the price to buy one.
Okay, interesting.
So that's basically the economic cost of Bitcoin. Sounds quite oversimplified and interesting on its face, but once you get into perfect competition, which we will soon enough, it kind of makes a lot more sense.
Okay, sure. Yeah, look, overall, I think the report's really meticulously researched and everything. One area where I am probably a little more skeptical is around the usage of the sort of perfect competition. I suppose I sort of identify more with the Austrian School of Economics, and I believe that, from my point of view, it's almost like setting up this kind of caricature almost of what markets are when, they don't sort of match up what people kind of draw up on a blackboard. However, I think it is useful to think about things in terms of what is the incentive of the miners, and what is the response, let's say, if the hash rate rises, based on, or if the electricity price rises. And so I think that's the way, that you can analyze that. And I think to your credit, in your report, you've done a lot of that. So so let's kind of dive into that a little bit further. But maybe it would be good to sort of go with a bit of a overview on what are some of the key Bitcoin mining metrics that you mentioned in your report. So, for example, the dollars per gigahash, watts per gigahash, and so on.
Those are the big ones. Those are really the things that drive everything. What your dollar per gigahash is on Capex, and not only your watt per gigahash efficiency, it's also the price that you can buy electricity for. That is a huge factor in the cost to mine. But bear in mind that the Capex component of the cost to mine a Bitcoin is about 2/3, with the electricity only being about 1/3, based on the electricity price assumptions. So I assume that the big miners buy electricity for about 2 cents, and most other miners on the network have access to a 4-cent electricity.
Excellent work. Okay, and then how would in your report you talk about how some of the metrics have differed, but from 2015 to today in August 2018.
Oh, the change has been monumental. So but more interestingly, I'll give you the data for January 2015 up until the date of the report, which was literally 2 weeks ago to the day. So in the past 5 years, dollars per gigahash has dropped 94%, and in the next month or so, it's about to drop another 20. So we have a same thing with watt per gigahash. So watt per gigahash is down 89%, and in a few weeks, it's about to go down 30. So there's the Avalon A9's coming out, the Shenmue M10 on the new 7 nano circuits. So look for cost of mining to go down substantially over the next 2, 3, or 4 weeks when these rigs start to come online.
Wow. Okay. Very interesting. Okay. Yeah. So, and the other point that I can see from your table is you've got there the January 2015 network hash rate is 295 petahash, and then what's the rate now?
So it's in June it was 36,300 petahashes, but I think today it's something like 43,000 or 43 exahashes.
Yeah. So
quite a decent amount, and it grows fairly consistently. So since 2009, it's averaged 9% a fortnight, and that's over several hundred fortnights.
Yeah, that's a really very dramatic increase in the difficulty, and
so if you have a look at the rule of 72, every 7 or 8 fortnights the hash rate doubles.
Yeah, that's definitely a very steep inclining curve.
So if we look at it again, July 2021, it'll probably have grown again another 12,000% from what it is now.
Yeah. And I think the other thing is, what about that aspect of kind of getting close to the edge of human kind of capability, like the best nanometer chips and that? Would you be able to outline a little bit on that?
Yeah, that's a big sort of philosophical discussion right there. So there's a couple of scenarios at play in terms of human capacity, and eventually, because I'm a perfect market economist, perfect competition economist. Yep. I do believe that no barriers will be hit. I firmly believe that the market demand is too strong for a wall to be hit, a major dramatic wall to be hit on these kinds of things. We've seen walls being broken for consistently for 60 years, and I'm quite confident it'll go that way. But if it doesn't, then you'd hope we start transitioning to much more efficient, environmentally friendly sources of energy, or there's going to be quite a energy concern with the Bitcoin energy use.
Right, right, okay. And the other aspect is I like how you've got here a discussion here on the retail best miner. So you've got the Bitmain Antminer S5 back in January 2015, and as at June
Yep.
2018, you've got the Antminer S9i.
Yeah. So when I did the report, the S9 I was a bit cheaper, or quite a bit cheaper actually than its competitor, the Avalon. But the Avalon, they're about to release some mining rigs very soon, and they'll be blowing the S9J at least out of the water in terms of watts per gigahash. But it'll only be a matter of time before Antminer releases their S10, and the world moves on as it's been moving on for the past 4 years.
Yeah, sure, sure.
So, for example, when the S9 first came out, it wasn't putting out 14 and a half terahash. So I think it was putting out 12 terahash at 1350 watts, or even less. And at the date of the report, the S9i gave out 14 terahash, and now the S9J is giving out 14 and a half, all on the same power supply. So there is room for hardware overclocking and all that. So the competitive momentum is so strong. Like I said, an average of just over 7% hash rate growth every fortnight. Unless these people are innovation leaders or cost leaders, they'll go bankrupt as companies. So no matter what happens, there has to be innovation in the space, because in terms of cost leadership, there's very few savings that can still be made in terms of hardware manufacture costs and electricity prices. Like, you can't get much lower than 2 cents.
I mean, very interesting. Yeah, I like that. And so I think one of the other things that you discuss in your report is around kind of like a range of a dollar price range for Bitcoin mining profitability. And so you list that as a
Yes.
range between 5,400 and 7,500. Do you want to outline a little bit about what is driving those price ranges?
Yeah. So the 7,500, that was like the maximum top that like my model will spit out, and that's like the most unicorn fanciful assumptions. And the reason why I put that benchmark of 7,500, because the Bitcoin price was flying. So I'm like, it must be profitable for some people, but the lower estimates, so the estimate of 5,400 comes about if prices are even lower than 2 cents and 4 cents. So assuming the big guys are getting it, for even cheaper, that can drive price down. The other one is in the Capex, capital expenditure. So at the current average difficulty change, the cost to mine is 6,200. But if you assume that difficulty increase is only going to be, say, 5%, you don't need to buy that much new hardware to keep your share of the market. So the cost to mine drops all the way down to 5,400.
Yeah,
Now
okay,
in a
cool.
now in a market with very depressed and deflated prices, where you see difficulty start to drop, which is very, very, very rare, but we did see a difficulty drop a couple of difficulties ago when we dipped down into the 5,800s. At that point, the price becomes so prohibitive that people switch off their kits. And back during that week, my model was showing a cost to mine of about 6 grand, so it wasn't too far off. So those are the drivers. So difficulty change assumptions and electricity price. They're the big movers. If you go to the report and have a look at the sensitivity analysis I've made, that runs you through all of the different scenarios of all the six main drivers of the cost.
Excellent. Yeah, I like that. It's a pretty cool way to you can see how each different or the big fact for these big factors how the price shift or how the shift in that number drives a different change in the profitability or of the cost to mine, which in turn drives the profitability. Okay, and I think another area that was quite interesting to look at is if you go to page 7 in the document or 12 of the PDF, you've got a chart there just showing the breakdown of the Bitcoin mining pools.
Yeah.
Did you want to just talk a little bit about how has the Bitcoin network hash rate distribution, what does it look like now, and how has it sort of evolved over time?
So if so, this is also out of date. The shares have jiggled around quite a bit, and the reason for that, it's a short-term reason. I think until the whole Bitcoin and Bitcoin Cash thing is resolved and miners moving hash rates around, you'll see a bit of uh, need a bit of time to reach equilibrium and a market decision on that one. But basically speaking, in a perfectly competitive environment, or at least an a monopolistically competitive environment, a mature market will tend to have three or four big players eating up about 80% of the market, and a whole bunch of niche little players taking up the other 20. You see this in all industries, big banks,
Yeah.
big phone companies, you name. There's always a big four. So you as a big four banker, former big four accountant, you know all about the big four. So what you can see from the big hash rate is it's not three or four, it's about six big mining pools taking up about 80% of the hash rate, and a bunch of whole little niche ones. So I'm having a look at one, for example, Bitfury. They've got 1.8% of the market. Their niche is they build their own hardware and mine on their own hardware, and so on and so forth.
Yep. Okay. And I think I agree with the point about it's like that whole Pareto principle or that sort of
Exactly
power
right.
law distribution. You're very likely to see that is a common occurrence, and we are likely to see that many occur in many different industries and in many different instances. So yeah, I think that is a likely sort of outcome. Uh, do you have any thoughts on mining protocols? I'm not sure if you've gone into that sort of aspect of it, like comparison of say Stratum versus Beta Hash, and what other things that the miners are doing.
To be honest, I'm more of the philosophical, more of the poet than the quant when it comes to specific technical things related to Bitcoin and Bitcoin mining. So I'm
Yeah,
basically
sure.
a perfect competition economist,
Okay,
which
sure,
is the
sure.
easiest one
Okay.
to be because there's so many assumptions you can drop when you're looking at things from a perfect lens.
Okay, right. Yeah, I suppose that's yeah, it does allow certain ways of analyzing. I think it might be now a good time to go to that next page where we've got
Yeah.
the price to hash rate relationship matrix. I thought this was an interesting one. It might be good to sort of talk through each kind of cell and just understand what is happening at each level for
Yeah.
the miners and for the market in general. So
So
let's
let's
start with the top
Let's
left.
start
Yeah, go
with
on.
let's. Do you want to just start with actually what's happening right now? What the market is witnessing right now?
Yeah, sure. Why not?
So
Let's do
there's
that.
so there's six scenarios. One's a matrix, so they all have an option of whether they increase, decrease, or stay constant. So in the world of Bitcoin now, we are in a bear market, and the price is decreasing. So when you're in a bear market and the price is decreasing, but the hash rate is happening to increase, that means that one, there are some miners that are still profitable and staying online, but a lot of inefficient miners are starting to exit. Uh, and miners can also start to kind of prop up the price a little through their financial toolkit, options, hedges, all of that kind of stuff, and using their big cash reserves to buy coins instead of mine them, which can keep the price somewhat tracking along with the cost to mine. Now, if the price is still decreasing and the hash rate is decreasing along with it, that means that the hash rate will continue to decrease. until an equilibrium point is found between the cost to mine and the price to mine, and a little bit of margin on top of that for the miners. So those are the two scenarios in the case of a price decrease. Now, in the theoretical chance that the price is stable and constant, an increasing hash rate means that profits decrease because your price is the same and it's getting harder to mine coins, but your cost and innovation leaders will tend to emerge and capture more of the rewards. Now, if price is constant and there's a decrease in the hash rate, that means that there's only room for really short-term profits, and new miners can enter the market to cash in on the extra profit since there's less hash rate on the network. Lastly, when the price is increasing and the hash rate is decreasing, that's completely irrational. The miners that exit make the incumbents even richer, and new miners have an opportunity to enter the flow to capture those increasing profits, and finally, if the price is increasing and the hash rate is increasing, everyone's kind of happy, and miners start to enter until equilibrium is achieved between the price and cost. So it's basically those 6 scenarios are the steps in the dance of cost and equilibrium.
Yeah, great summary. I like. Yeah.
So they never ever reach. So cost of Bitcoin will never be the price. But if price goes to 20 grand and the cost is still 10, either the hash rate has got to go up 100 times so it can meet the price, or the price has got to come back down to the cost to mine. If cost to mine is 10 grand and hash rate and price goes down to 8, either the network's going to get really slow, or people like Bitmain that have made $2.5 billion in profit last year can get themselves, $40 million worth of Bitcoin and push the price back up to the cost to mine.
But I suppose those sort of metrics, those sort of attempts to just buy the coin to keep the price a little higher, they wouldn't really last in the long run, right? Like until there would need to be enough other people in the market also buying at that higher price, yeah?
Exactly right. But since it's such a volatile market, sharp market moves can happen, and lots of people lots of traders and whatnot get flushed out. So there's always an upward shift of the worm away from the cost to mine. Cost to mine goes up very slowly, because even though hash rate goes up quite quickly, watts per gigahash and dollars per gigahash go down quite quickly as well. So you might find this time next year the hash rate has doubled and the cost to mine has gone up 5%.
I see. Yeah. So I guess in some senses,
just because next gen is getting 30% cheaper.
Yeah. So it's driven by very good technological improvements, which are kind of also why the hash rate is rising so much.
Yeah. So we could hit a wall in about 4 or 5 years. When we're another couple, I think when we've hit our nanometer limit. But who knows where Bitcoin's going to be in 5 or 10 years?
Yeah.
The energy use could be very well justified.
Yeah. Actually, do you want to talk a little bit more about the nanometer limit?
I'm not sure. So I'm not sure about where that is exactly. But from what I've read, the next gen of Bitcoin ASICs might even be as small as they may even be as small as 7 nanometers.
Right, and that's already pretty close to what.
So I'm having a look here, and I can retweet that a little later. So the S9 is on a 16 nano architecture. The inner silicon is on a 10 mil nano structure, and that's a lot more efficient in terms of watt per terahash than the S9. The Shenmue is on a 16 nano, and that's That's almost half the watts per terahash of the S9, and the Avalon A9 it will be running on a 7 nano, and that's even less watts per terahash.
Okay. Yep. Yep.
So the S9 is doing about 95 watts per terahash as of the S9J. Date of my report, it was doing about 98, so that's improved a little over the past 2 weeks. But the Avalon will be 60.
Okay.
So off the bat, you've got a 40% reduction in your electricity costs effectively,
Yeah, I see. Okay.
and you'll probably be matched with the dollar per gigahash discount as well. But with that said, once all these rigs ship, you're probably going to see the hash rate go up by 50 or 60%.
Yeah, and that will then
You
again.
know, if it's 10% a fortnight, in 8 weeks, that's 50%. So cost to mine goes up really slowly. So if you're looking at it from a market's point of view, go on to your 1 week view and look at the 100 day or the 100 period EMA, and like look how low, like look how slowly that rises, and have a look at where price is right now. It's coming down to meet that 100 the 100 period EMA.
Okay.
I can do a screenshot of that and tweet it as
Sure.
well.
Sure. Okay, that's great. Yeah, I think that's an interesting way to sort of think about the way the mining kind of works, interacting with the price and the upcoming mining technology. Go on.
And look, the reason I say this is because we've got sort of real world proxies for it. Uh, one of the good ones is the price of a barrel of oil versus the cost of a barrel of oil. So when the barrel of oil was at $80-$90, everyone was happy. The gas fields in America were going strong. The tar sands in Canada, and then we saw the barrel plummet to $40, and then only the Saudis, uh, you know, could mine oil at a profit in the short term. But eventually, based on the forces of supply and demand, market speculation, all that kind of stuff, the barrel of oil finds its right, or its market price. And just like in the Bitcoin world, there's a lot of information asymmetry in the oil and broader commodity worlds. So I think they're great proxies to use.
Yeah, no, that's a thing.
BHP would not mine gold if it costed them $2,000 an ounce to get it out of the
Oh,
ground.
exactly, precisely. Yeah, yeah, definitely. And yeah.
But only problem is if BHP wants to switch on a mine, it'll take them about 3 years, and if they want to switch off a mine, it'll also take them about 3 years and a lot of money. So traditional commodities have very, very high barriers to entry
And how would you
and
compare that
exit.
with Bitcoin mining?
If you turn the switch on, you turn the switch off. So if it becomes, if price goes to a point, let's say price tomorrow flew for some reason, someone put down $50 million, because that's all you need to wreck the price. Put 50 million down on 50x leverage, cause the margin cascade up to $15,000. Everyone that's turned off their miners in the past 3 months will just click the miner on, and it's profitable again.
Yeah, yeah. I suppose I think has most of your analysis.
And then when the price crashes back down, they can turn their rigs back
Yeah,
off.
yeah, right. And I suppose that's kind of at the just the cost of having the machine and the electricity. But then I suppose you got things like space, labor, heat, and kind
Exactly
of the
right.
scale considerations, and potentially some of the software considerations as well, right? Like, so my understanding is that some of the big guys will really try and work hard to sort of optimize their software to make sure that the block propagation and all those other things are optimized for them to kind of get the
Of
best bang
course.
for buck. But
Yeah.
yeah, really interesting stuff. Like, to be honest, I'm not I'm not an expert in this area, but thought it'd be good to just get an understanding on those things. Okay, and then
I'd I'd say with software, considering the amount of money. So, for example, the amount of money spent on ASICs every fortnight at the current moment in time is over $100 million a fortnight.
mm-hmm.
So there's a lot of money spent on hardware. So if software fine tuning, you'd probably be looking at maximum a couple of $100,000 a fortnight to $1 million a fortnight for every big mining house to have a team of in-house full-time software guys. But yeah, that software tweaking is where competitive advantage is formed as well. Software and hardware tweaking. Engineering's always investment in engineering always has a good return.
Yep. Okay. So let's move into So we've touched on some of these topics before, but it might be good to go into them. So on page 11 of the report, you've got the discussion on economic cost inputs and drivers. So maybe if you could outline a little bit around capex, opex. First of all, for people who are a bit new, what is capex?
Okay, so capex is basically it stands for capital expenditure, and it's any expenditure on capital assets. So your capital assets, your ASIC hardware, so they go on your balance sheet. Server racks if you buy them, data centers if you build them. If not, they're operational expenses, and anything else you need to buy, cooling units, you name it. So anything that you buy and becomes an asset to your business is your capital expenditure.
Yeah.
So let's talk about how much capital expenditure needs to be spent. So for example, let's just use a nice round number. Say that there was 100 exahashes of hash power at this difficulty level. All right, and just to use another round number, my mining pool has 10% of the pie. Yep. So I'm providing 10 exahashes.
Yeah.
Now I predict that next difficulty cycle, the difficulty is going to increase by 10%. So the network will become 110 exahashes. Now, for me to maintain my 10% slice of the pie, I've got to have 11 exahashes next week. So I need to bring on an exahash of mining power if I'm to maintain 10%. Make sense?
Yeah.
So that's basically it. So if I've got to put an exahash on, I have a look at what my dollars per exahash are, and that's my capex spend. So it's all about managerial strategy and forecasting ability, really, to figure out the right amount of hardware to bring on in the cycle. Yeah. So that's where a lot of managerial economics comes into play.
Yeah, great point. It's really, they've got to just forecast and sort of think about how is their current hash rate compared to the overall pool.
And you'll see in the sensitivity analysis, at an assumption of 5% difficulty increase, the cost to mine is like $5,000, and at a 9% cost increases to like $7,500. So getting this right and wrong, miners will live and die by it. But because the cycle is quite frequent, they've got quite a lot of time. Usually they've got a lot of chances rather, to steady their course and adjust hash power as needed.
Right. Like example, if you overshot one time, then maybe you can just slightly undershoot for the next round to kind of stay in the right level.
Exactly. But from a discounted cash flow analysis and opportunity cost point of view, you probably would have been able to buy more efficient hardware had you waited for the next cycle, because the mining rigs are becoming so efficient, or so much more efficient so quickly, that if you bought an S9i last week, the S9J that you buy this week is already heaps better than the S9i.
Yeah, interesting point.
And there'll probably be a S9K. So the S9Js are shipping until like the end of August, and I'm telling you, September 1st, S9K will do 15 terahash, and that'll ship throughout September, and then either it'll release something new in October. And yeah, if you watch that, Antminer Shop or any of those other, minor online shops, you'll see that the amount of product they push through is unbelievable.
Okay. All right. So that's CapEx. Let's go into OpEx now. So what is OpEx and what are the typical costs that are involved?
So OpEx is operational expenditure, and that's just money to keep the operation going. So obviously keeping the miners powered up and cooled, which will probably be about 99% of your OpEx, and the rest is keeping the lights on, keeping the fridge on for the staff, the microwave, all that kind of stuff. But effectively, as far as Bitcoin mining is concerned, you've got aircon and you've got mining, and a lot of people don't know this, but aircon typically averages about between 30 to 40% of overall energy consumption in a data center. But a lot of the new technologies, there's a couple of very well-known now data centers that they're hitting the very low 20s, 20% efficiency. So because in the world of Bitcoin, innovation leadership is the way to go. I'd say in the big miners have quite efficient cooling systems, probably around the 20 to 25% range.
Very nice. Yeah, good explanation. Okay. And then so yeah, I think we've kind of the next section there you've got is difficulty cycle, which I think we've sort of covered already, where you basically have to sort of estimate. How about coins mined? What are the things that a miner has to think about from that point of view?
Okay, so that's a very deep economic discussion because obviously the coins mined, it's fixed. It's 12 and a half every 10 minutes. But the mining fees are extremely variable, and there's a lot of strategy which goes into, there's a lot of managerial strategy that goes into determining, which blocks to process and which blocks to prioritize and all of that kind of stuff to do fee maximization. I take the very oversimplified approach because a lot of people can't, myself included, can't process the very dense economics, and I just use the law of averages of Bitcoin's produced every block, and trailing averages for what the daily average miners fee was in aggregate, and then just using that aggregate for my per coin cost figures. So for example, now it's been pretty stable, around 40, 50 Bitcoins a day, but during the hype, at the peak of the bubble, over 500 a day for 2 months straight.
And that's just in the fees.
Just fees.
Wow, yeah. And I think that's really fascinating as well, because what we're seeing now is more in terms of the Bitcoin eco space, we're seeing more and more companies try to do things like batching such that they use the space more efficiently. And that has in turn led to the fees coming down.
Absolutely, and there's also a lot of work happening on the Schnorr signature front, which will add efficiency through signature consolidation. So plenty of things to look forward to if you don't focus too much on the price. And I think once you figure out how to calculate mining costs, it'll bring you a lot more sobriety about going to the moon. It's a slow and steady marathon.
Yeah, that's a good way to put it. Yeah, I think, we're waiting on the Schnorr proposal to sort of finalize the review and eventually, potentially being implemented. And then after that, then we'll have to look at, if that, assuming that does happen, then would Schnorr aggregation be put in and so on. And that's a whole cycle. So it might be another year or two before everything is kind of played out in that. So, and I think the other thing to think about with coins mined is obviously the every 4 years we've got the halving. And so I suppose at an equilibrium level, we would be thinking in order for miners to kind of stay level, basically the price has to double every 4 years.
Yes. So what will tend to happen is a lot of people will tell you from right now that it's already priced in. It isn't. Because it's extremely difficult to forecast, to set a managerial strategic forecast out 2 years. It's hard enough to do it on a fortnightly basis, let alone 2 years. So we're just going to have to see what happens between now and leading up to the halving. Market will decide what it wants to do. and the miners will follow suit. They'll either turn off their rigs, or the price will fly, and more people will join the market, or some market activity, hedging activity, and whatnot could go into play to give miners temporary breathing room, because a lot of these miners do have a bit of cash flow, to cop a downturn for a month or two, but not too much more than that. And I do believe the equilibrium is pretty self-correcting within a difficulty cycle or two anyway.
Yeah. Good points. How about power cost and emissions? Do you want to outline a little bit about what you're saying in this section here?
Yes, so unfortunately with emissions, there's no real way of knowing, because you don't know where the miners are mining. A lot of people say, yeah, China. A lot of people say, yeah, Iceland, here, there, everywhere. But the only thing you can do in that case is to take worldwide averages. So on average, the world's power sources spit out about 600 grams per kilowatt hour of energy. The good stuff like hydro and solar and whatnot only does about 20 compared to the 600. Coal and oil are the big monsters, but since they hold the 60% share of world energy production, and most likely the majority of miners mining in China will be mining on coal and oil, we're using that figure to judge Bitcoin's overall emissions. So it is, a reasonable enough proxy. Now, in terms of electricity prices, and according to the market data, us being in Australia, we pay 27 cents a kilowatt hour, so you don't have to really worry about mining in Australia. But typically, the world average weighted low price is 6 cents, high price is 12 cents. You put those two prices into my model, a 6 cent low price and a 12 cent high price, and you've got like a $12,000 Bitcoin cost. But with that said, there's heaps of not only just anecdotal evidence, but good solid evidence of tech towns in China. There's one in particular, Yunnan. They're hosting Bitmain in their tech city, and one of the incentives they've given Bitmain for housing there is 2 cent a kilowatt hour electricity.
Wow, impressive, hey?
There's a data center in Washington State in the US that's getting their hydro for 1.7 cents.
Yeah.
So because of the sort of perfect factors of mobility, which is one of the factors of being towards perfect competition, is that you can just move to wherever the cheapest electricity is, and because of that, I'm assuming lowest absolute cost for everyone everywhere.
Yeah. Well, I suppose that's the way you've got to think about it. So, yeah, I agree with that. Okay, and then the next section you got here is the mining mix, the network average miner. So you're talking about the two different types of miners.
Yes. So this is where the big difference is. So there's two types of miners, the big ones and the little ones. So the big ones, let's call them the chip fabs. So the chip fabs are basically they build the hardware, they mine on it for a while, and then they sell it to you. The little miners, they basically buy the run-in hardware from the chip fabs and run it at home. Either they can do that, or they can participate in the cloud mining phenomena if that still exists. Now, just based on some market data for chip fabs and the rumored practice of running in machines before shipping, regardless of whether they run in machines or not, a typical gross profit for a semiconductor business, is in the area of 45%. But the really good ones make around 60. So that's gross profit. So there's still, their net profits are much lower. But the reason I'm using gross profits here in the Bitcoin case is that their expenditure is built into the OPEX portion of the model.
I see.
So you can take gross profit on Capex.
Okay, cool.
So when they're selling you something for $1,000, it's only costing them about $400.
Okay.
So their returns are huge, and they provide a lot of the hash rate. So there's a rumor that Bitmain could be controlling by itself up to 20% of the hash rate, just based on the size of Antpool and the BTC.com pools. So you chuck in all of those other chip fabs that I talked about earlier, and you could say that chip fabs are about 35% of the market. Everyone else makes up 65%. The chip fabs get all the big discounts. They get the cheap electricity. They don't pay tax, and the little guys still get pretty cheap electricity, 4 cents. And when I say little guy, I do mean someone with at least a garage full of ASICs. Like a garage full of ASICs, you're still cracking out a good 150 petahashes. Like, you're putting out a decent amount of power. Your monthly electricity bill will be in the tens of thousands, and you'd probably consider that a little guy.
That's funny how far it's come.
Yeah.
Okay.
So yeah, like I'm telling you, we're putting on 5 exahashes a fortnight at this point.
Yeah. Okay. So let's go now into the discussion on comparative summary. So in your analysis, you go to kind of comparing Bitcoin against gold in terms of costs for manufacture, or in the case of gold, mining.
Yep.
Do you want to discuss a little bit an overview on this section for the listeners?
Yeah. So basically, again, it's hard to really capture the exact environmental impact of Bitcoin, but the proxy is whatever damage the global average electricity grid does to the planet, Bitcoin does to the planet. So so it's never Bitcoin's choice of what anyone does to it. Bitcoin's neutral and doesn't care. If you want to mine it on coal, you can. If you want to mine it on solar, you can. The more people mine it on solar and hydro, the more clean it is. The more people mine it on coal, the more dirty it is. So that's basically the long and short of it. So to calculate overall emissions, we have that weighted average number that I was talking about a few minutes ago, 600 grams a kilowatt hour. And if you just multiply that by the kilowatt hours of the network, you get the emissions. You factor in the energy needed to build ASICs, and you get your overall figures of about 100 terawatt hours a year or so. So with gold, though, it's a very, very involved process, and it's unfair to just judge Bitcoin versus gold in terms of CO2 emissions. So gold still emits more CO2 than the Bitcoin network, but not by the end of the year. So Bitcoin will eclipse the CO2 emissions of gold by the end of the year. But there's other factors. So, for example, freshwater ecotoxicity, eutrophication, carcinogenics, respiratory inorganics, just a whole raft of other really, really, really bad things for the environment. Just specifically because if you want to get gold out of the ground, you got to rip a massive hole into the ground. So look, I was actually preparing my video for episode 9, which is Bitcoin versus gold. So check this out. So for all the gold we mine every year, you can fit into a 6 meter by 6 meter by 6 meter cube.
Yeah.
That's how much gold we pull out of the ground every year. It's not a lot. So it's basically enough gold to fill up a small flat. But the amount of waste rock that's produced is, if you imagine a cone, with a 1 kilometer diameter, as tall as Mount Everest.
Wow. Okay.
So it's a lot of rock. It's like over 100 billion tons of waste rock. You've got to soak this waste rock in about I think it might have been something like 10 billion liters of water, and it's not only water; it's also a mix of 400,000 tons of cyanide in this water to leach the gold out of the gold ore.
Okay.
So it's not just CO2. Like, there is a lot of toxicity and side externalities. It's the same thing. It's the same thing with electricity costs. So if you were to work out, it was one of the justifications for a carbon tax. I don't agree with carbon taxation, but you can make the valid case that if you were to externalize the cost of coal power into its fair price of, say, 30 cents a kilowatt hour, cost to mine a Bitcoin will be up near 25 grand.
Right. Yeah, so now I think we could contend back on that particular point, that I think the kind of this concept of a, quote unquote social cost of carbon, there are a few flaws in that concept, but it's probably not in the scope of, this podcast to kind of go into that.
And I think as a libertarian, I'll agree with you on every single point on that.
Yeah, I mean, it is for good reasons. I think we just don't have the time to kind of go into it. Maybe, you know what? Maybe we could do another episode and talk into that.
Sure.
Yeah, but
Sure,
what about
sure.
actually I'm interested from an energy usage point of view as well. How would
Yeah.
Bitcoin compare with gold in your analysis?
So right now, uses the same or a bit more energy than gold at the moment. But Bitcoin, with every spike in hash rate, we have a spike in energy use. So give it by the end of the year, Bitcoin will be consuming more energy than gold. But the point goes back to the foreword of my paper, but also the externalization of costs. If BHP had to externalize its costs, gold would be worth like 6 grand an ounce.
Right.
So that's why when you start talking about energy use, so Bitcoin uses 0.006 of the world's energy,
Which is quite small, really.
right? So if you divide that market cap, it's too small. So if you divide that market cap, the current market cap, by 0.006% of global energy, you'll have a system that can effectively, let's say it was using up 100% of the world's electricity, it'd be, worth, a couple of 100 trillion. But if you were to give electricity a fair price, and assume that Bitcoin used 100% of the world's energy, that's enough to sustain a multi-quadrillion dollar, world economy. And if we can get our emissions down to zero, it doesn't matter how much electricity energy Bitcoin uses. It's given humanity sound money at last. Solved so many problems.
Exactly.
So the only danger of Bitcoin getting bigger is societal benefit, not really environmental impact.
Exactly.
Because the thing is, Bitcoin will get so big that it'll eventually drive innovation in the energy sector. So energy sector will see, there's a good niche here. I've got 10-15 billion dollars worth of customers that are going to be using energy 24/7 at a consistent rate. I can sell them energy at bulk prices, yada yada yada, and all over the world people will be vying for these companies, either effectively based on price and emissions rating. And as time goes on, solar and hydro and all those other technologies are just going to be able to blow coal out of the water in terms of dollars per kilowatt.
Yeah, no.
So I don't see it being a problem.
Yeah, that's a great point. And I think the other thing that's important to consider here, and obviously it's fantastic to, compare what is the real cost in terms of energy, how much energy are we using, but the real true cost of a monetary standard in an economic sense is the monetary standard that you have foregone, right? And if, the easy money, fiat money of the world enables like warfare and all these other things, that is also a cost, you know? So it's almost, you know, people have this kind
Absolutely.
of funny conception of you know, as though the world was perfect. You know, like one analogy I've heard some people use is to say, oh well, you know, if the world was perfect, we wouldn't spend any, you know, if there were no bad people, we wouldn't lock our doors, and therefore the cost of locking our doors is, you know, waste. But that's the reality of our world is, you
Yeah.
know, we do need to lock our doors, you know. So I think that's also an important comparative to lay as well, to think about, well, if we didn't have sound money, then we would have, you know, an unsound money, and what does that enable, you know? So that's what people have to sort of also consider when it comes to this. Yeah, but fascinating
I'll
research.
tell you what unsound money. I'll tell you what unsound money enables. Turkey, Venezuela, Iran, and those are just examples from the past few months.
Exactly, exactly.
So we can see what's happening with unsound money, and I think we might see this accelerate in the next 3 to 5 years. Actually,
Yeah, yeah. I think we could. I mean, who knows, really? But yeah, fascinating stuff. So let's now go into what you've got in your conclusion of your report. So I think a couple of the points, some of the highlights that you hit here, you talk about how, okay, yeah, we're potentially using as much energy as Ireland. The Bitcoin cost per transaction.
oh, far
Yeah.
more.
Oh, more than.
So if Bitcoin was a country, it'd be around 26. After I think just after Kazakhstan
Oh, wow. Okay. 26.
uses a lot of uses a good amount of energy. So yeah, Ireland's ranked pretty low in the total energy usage. They're only a small country. You got to look at the big ones. Your China, Brazil, you know, USA, India, Pakistan. That's where the big power gets used.
Yeah, yeah, and then yeah. So you also point out the potential, and I think you were touching on this earlier around the potential for Bitcoin mining companies to vertically integrate up the stack. So I think that's a really cool point.
Yes, yes. I think this is the evolution of a market, Stefan. You know it as well as I do. Eventually, that's how you get your consolidation. That's how you get your big three or four. They end up, you know, going up and down their supply chain and side to side, and you know, create a virtuous ecosystem. So there will be mining companies that have a brokerage arm that make a hardware wallet, you know, that have an exchange, you know, that have, you know, that's just what'll end up happening, and they'll probably have their own power plants and data centers and all of that as well.
Yeah, and we've got to consider the size
Eventually,
here, right? Like, if Bitcoin now is what, 130 or 140 billion ish as a total market, and the market for gold is about
yeah.
7 trillion. Now, I think probably a good
Oh
proxy
yeah.
for global money would be around 90 trillion. In terms of, that's
Hmm.
the US M3 broad money US dollar kind of value of the world in terms of the money supply.
Yep.
You know, then you got to think how much more this thing can grow.
Oh yeah. So much more. Uh, but like I said, it's a marathon. The hodlers know what I'm talking about. A year is a very short time in Bitcoin. I don't know how the traders do it on the hourly. I couldn't imagine a harder life.
Yeah, definitely, definitely. Got to be very kind of yeah. I'm not really a trader myself, so I can't really comment.
Yeah,
But
so you
yeah,
can see just in 2 weeks the leaps and bounds. You know, things can happen. So yeah, there's a very long road ahead. I'm not sure we'll see McAfee numbers uh,
mm,
so soon,
yeah,
but I believe that we will see them.
sure, sure.
But yeah, uh, maybe towards a little later towards John's lifetime.
Yeah, yeah. Maybe. Who knows? Who knows?
Maybe another 10, maybe 10, 15 years.
Yeah,
But yeah, he's
I
a
think it's yeah. We're
little
in the
bit
decade
ambitious.
range. Yeah.
Yeah.
Okay. All right. Well, I think we're sort of getting to the end of an hour, so I think it's probably time to start wrapping up. Do you have
Yep.
any final comments, Has?
That's about all. Like, thanks for having us. there's a whole lot more content coming out over the next couple of months, and probably continue doing something regularly on a weekly or fortnightly basis. So do all the social media stuff, like, subscribe, follow, all that kind of good stuff, and yeah, I suppose we'll catch you next time.
Yeah, sure. Okay, guys. So, guys, you can find Hass. Now, Hass's Twitter account is Hass McCook, spelled HASSMCCOOK. And as Hass mentioned, he's got a video series coming out, and he's got basically one video coming out per week and a accompanying blog post with that video. But if you're impatient, like I was, and partly because I wanted to help present this early, you can go and get the full report. I will put the link to that in the show notes page. So is there anywhere else you would like the guys to find you online, Hass, or your LinkedIn? I'll put the link for that. Anywhere else?
Yeah, sure. So LinkedIn, Twitter, YouTube. Subscribe on YouTube just so you can get the notices when those videos are up. I generally post evening time on Sunday for the Aussies, so the Europeans get it in the afternoon and the Americans when they wake up. So it's easy Sunday viewing.
Excellent stuff. Okay, guys. Okay, thanks for that, Hass, and I'll speak soon.
No worries. Thanks so much for having us. Thanks for
Yeah.
listening.
Okay, guys, so that was my conversation with Hass. You can find the show notes on my website, stefanlivera.com. Search SLP12. This is episode 12 of my podcast. Lastly, subscribe to the podcast, Stefan Livera Podcast, on all the podcast directories like Apple, Stitcher, Spotify. If you got value out of this, please share it on your social media, and also come follow me and give me feedback on Twitter, @Stefan Livera. That's it from me, and I'll speak to you guys soon.